Welcome to Every Dollar Counts with Josh and Jay, a shot of truth serum for your investment and insurance questions. I'm Josh Knoll, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, director of the Gulf Coast for Concourse Financial Group. We are brought to you on the Gulf Coast Financial Advisors Podcast Network. Well, listeners, we've kind of thrown out the whole saying that we don't timestamp our episodes because honestly, Jay, ever since COVID hit, like everything seems to have like a mile marker.
Well, people need to know when they're listening to our episodes, we're talking about something that's probably current or within the last couple of weeks or month.
Yeah, when we originally set up the podcast, we were thinking, hey, we're going to do mostly evergreen topics, and then we'll hit the topical items as they come up. Well, honestly, since COVID hit, it seems like every month, sometimes every few weeks, or something pretty topical of mind. Well, so with that said, we are recording. It's June 14th. We're coming
Flag Day.
Flag Day, yes. We're coming on the heels of a pretty significant market correction, and that's going to kind of frame the topics of our next three episodes. First topic today we're going to talk about with this episode is going to be what I'm loosely calling fear of missing out. FOMO, the pressure to invest typically towards the end of the bull market, which sometimes can lead to the greatest regret, and we're going to tie that in with some of Jay and I's personal experience living through the dot-com era, and kind of talk about the difference between quote-unquote gambling style investing and the difference between that and a diversified portfolio. Next episode, as you go, we'll listen along, we'll talk about the difference between bear and bull markets and some of the things that folks typically do when they're trying to accumulate wealth. And then we'll tie that all in with the big word of the day, which will be inflation, rising rates, things of that nature. But for this episode, to kick it off, we're going to dive into the difference between gambling investing and diversified portfolios, and we're going to stitch that together with fear of missing out, FOMO, as Jay said, and also talk about how that puts pressure that sometimes leads the most regret down the road. But before we get into all that, let's have our friends from Sloth Racer kick us off. Jay, buddy, how you doing, man?
Josh, I'm doing well. Good to be with you here in studio at Deep Fried with Johnny and his pets and all the activity down here at the offices down here. So it's hot outside. It's June. Feels like it's the middle of August. Man, I don't know.
It's about to get worse.
It looks like it's going to get worse. Everybody listening to this, keep your air conditioning on, and golly, if you have anything going on at the house and you think you need to change your filters, do it.
Well, listeners that are new to the show, we record in downtown Mobile, Alabama, here on the Gulf Coast, and we kind of serve the Gulf Coast. We're over on the Eastern Shore where my office is in Fairhope, and it tends to stay pretty hot and pretty muggy down here for a long period of time.
A lot of humidity.
But as I was showing Jay, where I'm from, which is Wappapello, Missouri, which is in southeast Missouri.
Can't spell it, yeah,
Wappapello. It's going to be in the hundreds consistently over the next week and a half, which is a little alarming. My dad's the one that alerted me to that, but that just tells me that it's hot.
It's hot, and I'll be on the golf course with my junior golfers and a bunch of kids over in Dothan, Alabama next week for the Future Masters, and it's going to be hot.
Well, let me sound like a radio guy here, Jay, so let me tell you what's not hot. Stock market.
What's not hot?
The stock market is cooling significantly. Inverse relationship with what's going on with our weather right now. So I'm going to frame the episode this way, Jay. What I want to talk about is the difference between what I'm going to loosely call quote-unquote gambling investing. And here's what I mean by that, listeners. I mean, if you are heavily concentrated in an individual stock, maybe even particularly a penny stock, which means something that, generally speaking, has $1 per share value or less. Meme stocks, which, to be fair to the listeners, I'm not super educated on other than just kind of watching them come and go with the different things that people were doing. And then we're also going to talk a little bit about crypto, some. We're going to be trying to be gentle with our producer, Johnny, who's had quite a run with crypto. And then we're going to kind of compare and contrast that with a diversified portfolio, again, I hesitate to use this term, Jay, because it can imply value where maybe not necessarily it's intended to, but let's say quote unquote quality investments. And that's why this matters when you're trying to figure out what direction to go.
And with my current FINRA registration and your past history of financial advice and financial advising firm, we need to make this clarification on the front end. Today we're not, and on any of our episodes, do we ever make any recommendations that an individual will do anything specific to their portfolio, make any purchase of anything specific. What we're doing today is just giving you our experience, what we're hearing in the marketplace, what we're seeing in the marketplace with respect to the economy and the volatility in the stock market market indices and the different ways that you can have your money work for you. So by no means are we trying to give you any specific advice. For that type of tailored advice, we suggest that you have a conversation with a financial advisor, somebody like yourself, Josh, that you can have an education, sit down in an education and understand the ramifications of investing.
Well, okay, so Jay, let me do this real quick. Housekeeping for compliance. Jay Stubbs and Concourse Financial Group are not affiliated with Prime Capital Investment Advisors, Qualified Plan Advisors, or Gulf Coast Financial Advisors. And me, Josh Null, I'm not affiliated with Concourse Financial Group. So Jay, what I want to do is let's leverage you and I, our age, and the fact that we've lived through a couple of these boom and bust cycles, but we're going to specifically hone in for our episode with the fear of missing out. And we're going to talk about our experience through the .com era, because you and I are both coming out of college at that time period. We probably had our first jobs. We actually had a little bit of money in our pocket. And I can specifically tell you a couple of things I remember from that time period. One, it seemed like every other person I met was a day trader. And two, there was significant pressure on even average investors, even new investors like I would have been, to catch the next big thing. So the reason I'm saying that is, history doesn't repeat itself, but it sure does rhyme. Do you see any similarities with what we lived through in our 20s, young 20s of the .com and what we're seeing now?
I see great similarity. I started as an intern working for a boutique financial planning firm in Birmingham right out of, or in the last 2 years of my college years, and then went straight into the investment side, went through and got my series registrations. So yeah, I've seen a lot of similarity between those .com type of, and if you're listening and saying, what are they talking about, the .com?
Right. Fair.
When there were businesses that were formed that were purely internet businesses. Well, those of you listening to this today say, well, that's all what the business world is, right? Internet, everything's a .com or a .net or a .whatever. But there were companies that were putting out business plans specific to the growth of the internet business model. We know today that the major players took advantage of that. Google, Amazon, the social media platforms, all of them took great advantage of that opportunity. But there were other Pets.com,
yes.
WebMD.com. All of it was based on the premonition that, hey, we're going to attract people to our websites. We're going to be able to generate revenue through ad sales, through subscription services, whatever the case may be. And those types of companies were in vogue. They went public, and people had the choice to buy those companies' public stock and take a risk. And some of them made it, and a lot of them didn't. So there was a bubble that burst, and that happened in the mid to late 90s. Late 90s into the early 2000s. And a lot of those portfolios that people had, a lot of .comers, some sold out and made money, others did not. The analogy I like to give here, Josh, is something we're in the middle of and we just experienced, which is the horse racing. If you listened to this and you went to a Kentucky Derby party, maybe you had an invitation to go hang out and watch the race, and you maybe heard some people around the table or at the party saying, hey, I'm gonna bet on XYZ horse. And you had that, oh, I should do that. Were you doing it because it sounded like fun, or were you doing it because you legitimately thought you could make money on that gamble or that investment of that horse win, place, or showing? If you did it just to have fun, then this type of market is not for you.
Right.
You wake up the next day bloodied and bruised, and found out that your investments, you couldn't stomach it. So if you're doing it to make the money, you need to do it with the right education mindset, and you also need to have the proper guidance and advice from a financial advisor, somebody like yourself.
Well, I think that's a great tee up for this, Jay. Like the pressure you feel at a Kentucky Derby, or the pressure maybe at a Super Bowl party to do the little square things. That's social,
or the casino with friends. Yeah.
Right. So that's social pressure, right? And what that leads into, our central topic of the day, is fear of missing out. Is that pressure? There's 2 points on that. One, that pressure you feel in a social setting, and it's we're making it sound like everybody's yelling at you to gamble. It's not that. It's just you want to be part of the group. You want to be invested in what they are all doing.
Oh, I got some of that,
right?
Well, I got some of that.
Well, take that times whatever the number would be with social media. Now the pressure is not just coming from your own little personal circle of friends. It's coming from people you've never heard of all across the place, telling you this is the next great stock. This is the next great. Hey, let's pump up this meme stock. Hey, let's do this crypto thing. All this kind of stuff. I want to make sure I'm clear on this. I'm not saying this from a judgmental tone. What I'm trying to convey to listeners is there is an inordinate amount of pressure in any bull market, particularly at the end, for people to jump in even when they're not necessarily comfortable in that style of investing. And it tends to increase the most once we start getting to the top of the bull. If you look back in history, I can't cite the specific study, but I can tell you there's absolutely a psychology to it that there is more, the pressure mounts the longer the bull extends. Well, that's all fine and good, but typically what happens when someone feels pressured and they come into a position that they're not necessarily comfortable for, definitely doesn't fit their risk tolerance. And when the bull stops or it pops even, they tend to be the ones that experience the most regret.
It's the old buy. They end up buying high,
yes,
and selling low because they can't stomach the volatility and the downturn.
Right.
Which is the complete and opposite of what we should be thinking when it comes to investing. We want to, you get into something at the low end and ride that wave up. So buy low, sell high, or hey, let's avoid buy high and selling low.
Well, and so here's the thing, and full disclosure, there are many different ways of doing quote unquote the advisor role that you and I served are very constituents. There are guys that are what we loosely refer to as stock jockeys. There are brokers. There are fee-based advisors like myself. There are people that do hedge funds. There's all these kind of different things. We're going to be kind of drilling this down to our side of the aisle. In doing so, I want to make sure that we don't sound like we're being judgmental of the things I'm going to list. But what you see with the fear of missing out is you get pressure to get into individual stocks. Now, we offer portfolios of individual stocks. So again, don't get me wrong. I'm not saying it's a bad thing. What I'm saying is typically when you see things like this happen, where the bull runs up and then you've got a significant correction, is you've got people with a significant portion of their investment portfolio in one or two stocks.
Yeah,
right?
And that's a recipe for disaster if they didn't intend it to be that way.
Right.
They're really in a bad spot.
Right. And even, again, not to hit on penny stocks, I think penny stocks, in my opinion, were more of a thing back in the .com era. In fact, I even, lost $500 on some penny stocks back in the day. And then meme stocks, which is kind of a new thing, I think, related to social media. And then again, apologies to our producer, Johnny, but crypto. And again, I don't want to sound judgmental. I'm not saying crypto's dead. I'm not even making a judgment call on any of that. That's a topic for another day. The point of it is what you saw was this flood of money come in, particularly after COVID, when we had liquidity increased artificially to a point never seen in history. You've seen a significant amount of folks going into individual stocks through trading apps like Robinhood. You saw people doing meme stocks for companies that did not have the underlying revenue to qualify for it. And again, not to pick on crypto, but you saw people get into things that maybe or maybe not even had a business case to have, right?
Correct.
And so what tends to happen, what you all are seeing, in my opinion, is not only are you seeing a resetting of the stock market, you're seeing a correction, if you will, but I think it's being exaggerated a little bit by the fact that we had so many people that were typically not that style of investor, because they felt like they were missing out, they got into those style positions. What do you think?
I think you're going down the right track. I also think the everyday average Joe investor, has very little bearing on what the market will and will not do, meaning there's a lot bigger companies and funds who are controlling that volume day in and day out on the different indices. So when you turn on the news or you're flipping through your phone and you see that the markets are all in red, that would be the Dow Jones Industrial Average, that would be the S&P 500, that would be the NASDAQ, and the other indices, you're seeing everything kind of take a downturn. And that's because some of these companies are capturing some gains that they've had, and others are just saying, we don't feel good about this situation. The individual investor with his or her individual portfolio, whether it's a different series of individual holdings, or if it's different funds or ETFs or what have you, they're feeling the impact and watching those go down as well.
And it's unsettling.
And it's unsettling. Now, I want to make a point here, Josh, and we talked about it with Johnny. You never really have realized a gain or a loss until you've executed the sale. So when you purchase a portfolio or a position in a portfolio or a fund or any investment, you've never really realized a gain or a loss until you have made the decision to sell that investment. And you do that in a portfolio, you do that with your advisor. If you have a car, golly, the car market's really weird right now too. You buy a car for X and weirdly, the used car values have gone up the last year. You could sell that used car for more than what you bought it for. Wherein have we ever seen that?
Never.
But if you actually go through the transaction, you've realized a gain or a loss. And that, without getting into a lot of the details of the tax ramifications of capital gains and all that kind of stuff, that's a decision you also have to make. When is the right time to get out of the position in an investment?
Okay, so that's a great point. That leads me to kind of the second part of this where we described the problem. Now let's talk about potential solutions or maybe an alternative way to look at it. So Jay, back in my real estate days, I had a banker, and when 2008 came along, he said something that stuck with me. He said, Josh, this is just the great cleanse. This is the market getting quite a bit of the fat off the meat. It's cleansing out things that should not be in the market. It's resetting back to fundamentals. That was his terminology. And he said, what you're going to see is you're going to see a flight to quality and you're going to see a flight to safety. Now, back then, because we didn't have liquidity artificially pumped into it like we did after COVID, that flight to quality, that flight to safety took a couple years, whereas after COVID, that thing took like a couple weeks, right? It jumped right back in.
Absolutely.
Yep. So my point is, what we're seeing here is a flight to quality, a flight to safety. One thing that I think that was out of vogue that may come back into vogue, in fact, I can tell you it already is coming back into vogue is diversification. So we started out this, and again, compliance, I can apologize ahead of time for calling it gambling investing. I know in some form or fashion, all investing is gambling to a certain degree, but what we were referring to was people heavily concentrated in individual stock positions, penny stocks, meme stocks, crypto, things of that nature that really didn't have the risk tolerance or the expertise to necessarily be comfortable long-term with those kind of things. One way that we've seen, again, come back into vogue is diversified portfolio. So I'm going to set the table, Jay, and then let's talk a little bit about that as we start wrapping up the episode.
And when you hear the terminology diversified portfolio, what you may be saying, what do they mean? What are they talking about? Well, think of it in terms of the boxes of crayons. That is, the brand new box of crayons is a diversified portfolio of colors. A portfolio well diversified has lots of different types of investments, lots of different types of funds or ETFs, and everything is allocated proportionately. You choose the allocation percentages. You could be heavier weighted in one versus another, and you can also have that diversified portfolio shift as the market does. Some fund managers will do that for you, or you can work with an advisor and you guys can make that decision. So diversified portfolio, the image in your mind, in my opinion, is a very colorful 8 or 16 box of Crayola crayons.
Right.
You want a nice array of diversity in there. Over time, some of those crayons never get used. I don't ever remember using that skin color ever. But you the reds and the greens and the blues and the purples get used a lot, and that means that the diversity of the box has changed. Right. So too do your investments as you move down the road and down the path, and you have to reallocate. So diversity of portfolio and then reallocation of the portfolio.
And just by its sheer construction, typically diversified portfolio is going to have a certain percentage of equity holdings. A lot of times that's going to be in ETFs or mutual funds of some form, some individual stocks, and then it's going to have some proportion of fixed income instruments, debt, things like that. The percentage ratio historically has been kind of dependent upon your risk tolerance. If you were a less risky person, you would have a greater percentage of fixed instruments. If you were a more risky person, you'd be more heavily invested in equities. But just by its sheer construction, what it meant was you would not always have all winners. Right?
No, you wouldn't have all winners and you wouldn't have all losers.
There you go.
You would have a mix of some of everything, and over time, you'd hope to capture some sort of average rate of return of that portfolio. What's neat about diversified portfolios is you can back test. You can go back and look at the historical performance. I'd like to repeat for compliance that historical performance is no guarantee of future results. Right. Everybody should know that. But even in historical performance of testing your diversified portfolio that you have allocated as such, you can look at it and say, hey, this in the past has gotten an average rate of return of whatever that number is. And then you plug that into your calculator and say, does that make sense for us? Different things have different risks weighted to them, and that could affect the allocations and it could affect the diversity, but it will certainly have a bearing on your average rate of return.
Well, Jay, I'm going to say this in summary because as you and I have joked at our past episodes, at the end of the day, grandma was always right. Don't put your eggs all in one basket. Diversification is not the end all be all. There are obviously going to be pros and cons with any type of investment portfolio, but the point of this episode is one to hope you all understand a little bit more about what you're seeing with this correction and why it's a little different than the ones in the past, even though history doesn't repeat itself, but it does rhyme. There are some similarities. But on the other hand, don't give up. On the next episode, we're going to talk about what they mean when they say fortunes are made in a down market and collected in an up market. And we're going to tie that in when you should cut your losses, which is going to kind of tie back into us talking about individual stocks and things of that nature. When do you cut your losses? There are ways to go about this with your individual positions where you're not giving up, where you start moving into the old boring diversified portfolio, and you continue on your journey. Don't let this set you back. Like Jay and I saw so many .com people get set back in the day that never, if they ever got back into investing, they were years and years behind, and they were burned from it. So there are ways out there to get invested. There are ways where you're not going to see this crazy ride on your individual position. You're never going to insure against losses or gains unless we talk about some other different type of products, insure against losses. But there are ways where you can put together a quality diversified portfolio that kind of helps you pass the pillow test, like our good friend Will Stye says. Can you sleep at night when you lay your head on the pillow? I'll give you a final word.
If there's anything that you're gleaning from this last couple 15, 20 minutes, it's number one, if you've been doing it on your own, maybe you don't want to do it on your own anymore. Number two, if you thought you were tolerant and you realize that you are not because you can't sleep easy at night.
Everybody's taller when the market goes up, and up.
Oh yeah, a rising tide lifts all ships, but so too does a sinking tide. Everything goes down in the sinking tide as well. But if you didn't have the proper risk tolerance, then maybe now is the time to sit down and have a proper one taken care of. A financial advisor can help you do that. There's some neat tests to do that. But at the end of the day, we are in a correction at the moment. What we see in the future, nobody knows, but to be mentally prepared and educated, and those are two very important things, and not just ride the party wave and say, hey, let's jump on because everybody else is jumping on.
Very well put, my friend. All right, well, listeners, if this topic applies to you, and if you're an investor currently, it probably does, you can reach out to us to start a conversation. You can call 251-327-2124. Leave a message if you don't catch me. Plus, you can visit gulfcoastfa.com. That's gulfcoastfa as in financialadvisor.com. And then also, for all you independent and semi-independent advisors and agents out there listening and interested in the value that Jay Stubbs could bring to your practice, you can find him at jstubbs.com. That's JAYSTUBBS.com. All right, my friends, another show in the can. Also want to thank our producer, Johnny Gwynn, Deep Fry Studios. Thank my co-host, Jay Stubbs. And as always, a huge shout out to all of you that have joined Jay and I on this journey, and to those of you that are joining us now. Do me a favor, please subscribe on the Apple Podcasts app or wherever you get your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, if you like the show music, go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.